Hey everyone, welcome back to Corporate Decoder, the place where we break down the boring stuff so you don't have to get ready for a twist in a biotech deal that might make or break ESSA Pharma Incorporated. Today we are diving deep into ESSA Pharma Incorporated's latest filing an 8K report that signals a significant shift in their business combination agreement. Think of it like a puzzle piece being moved right before the picture is complete, and it changes how that final picture will look. ESSA Pharma Incorporated is a company operating in the biotechnology space, and like many in this field, their journey often involves complex deals to bring new treatments to market. This particular report is all about an amendment to a key agreement they have, a business combination agreement, which is basically a plan to merge or combine with another company. So what changed on the 23rd of September 2025? ESSA Pharma entered into an amendment to their business combination agreement. Now this is not just a small tweak, it seems to be a substantial change that affects what the shareholders get. Originally, this deal was set in motion back in July of 2025, and it involved ESSA Pharma combining with two other entities, Xenotherapeutics Incorporated and Xeno Acquisition Corp. And there is also mention of Exoma Royalty Corporation in the mix. Now let's talk about what this means for the people who own ESSA Pharma stock, the shareholders. The original deal likely outlined a certain payout. This amendment means that shareholders are now expected to receive a different amount. Instead of the original estimated aggregate distribution of about $1.91 per common share, they will now receive approximately 12 cents per common share at closing. That is a massive reduction from the original plan, but here is where it gets interesting. This 12-cent per S-share payout is excluding something called contingent value rights, or CVRs. These are like promises for future payments based on certain conditions being met. The report states that shareholders will also receive one CVR for each common share they hold, and these CVRs could be worth up to about 14 cents per CVR. Scroll the potential CVR payment of $0.14 per common share represents up to $6.7 million in the aggregate time center. This means that in total these CVRs could potentially add up to about $6.7 million. What determines if shareholders get this extra cash? It is tied to the outcome of certain potential liabilities that the company is dealing with. In simpler terms, there are some financial risks or unknowns that the company is trying to account for. Scroll the company and Xeno are making this change in light of potential liabilities, associated expenses, and the latest estimates of the company's expected cash balance at closing. Into the reason for this change, ESSA Pharma and Xeno are citing potential liabilities, upfront costs, and updated estimates of how much cash they expect to have when the deal is finalized. This is a common scenario in mergers and acquisitions where unexpected issues can pop up that require adjustments to the deal terms. Scroll on the 24th of September 2025, the company issued a press release announcing the execution of the amendment. Sign Center following the announcement of this amended agreement, the company also issued a press release the very next day, the 24th of September 2025. And what did this press release do? It announced the amendment, but more importantly, it signaled a change to their special meeting. Scroll announced its intention to adjourn the special meeting of the shareholders, option holders, and warrant holders, special meeting Sign Center. This special meeting originally scheduled for the 29th of September 2025, where shareholders were likely going to vote on the original deal, is now being adjourned. It will be reconvened on the 3rd of October 2025. This gives everyone a bit more time to digest the new terms and potentially file updated materials to reflect these changes. Scroll title of each class I center, let S quickly look at their current trading details. ESSA Pharma Incorporated S common shares are traded on the Nasdaq Capital Market under the ticker symbol EPIC Scroll Exhibit 2.1 Amendment Agreement to the Business Combination Agreement, Sign Center. The real meat of this report is the amendment itself, which is filed as Exhibit 2.1. While we do not have the full details of that exhibit in this document, without reading it directly, we understand its implications from the 8K scroll forward. Looking statement C Center now, as is standard in these filings, there is a whole section on forward-looking statements. This is basically the company S way of saying, hey, we are making predictions about the future, but things could change, and these are not guarantees. They talk about risks and uncertainties, and this is crucial. Scroll many of which are beyond the ability of the company to control or predict a centina. They explicitly state that many of these risks are beyond their control. This includes things like the completion of the transaction itself, potential litigation, disruptions to their business from the deal, retaining key employees, and even broader economic or regulatory developments. scroll through risks and uncertainties pertaining to the company's business, including those set forth in the company's annual report on Form 10, K dated the 17th of December 2024 Swine Center. They also point to their previous annual report for more risks. This is like a company saying, if you want to know all the ways we could fail, read this other massive document. It suggests there are underlying vulnerabilities in their business beyond just this merger deal. Scroll any potential litigation relating to the transaction that could be instituted by or against the company, Zeno, XRC, or their respective directors, or officers see center one specific risk they highlight is the possibility of lawsuits related to this transaction. This can happen when shareholders or other parties feel the deal is unfair, or that proper procedures were not followed. Such litigation can cause significant delays and added costs. Scroll the possibility that the transaction may be more expensive to complete than anticipated, including as a result of unexpected factors or events see center. They also acknowledge that the transaction might end up being more expensive than they initially thought. This is a very honest admission, and it underscores the uncertainty surrounding the deal, S final cost. Now, let S put on our investor hats and look at this. The reduction in upfront cash for shareholders from roughly $1.91 to $0.12 per S hair is a massive change. It means a significant haircut for those expecting a certain return. The subsequent CVRAs offer a glimmer of hope, but up to 14 cents is not a guarantee. It is contingent on factors that are clearly causing the company concern, indicated by their mention of potential liabilities. Essentially, ESSA Pharma is de-risking the deal for itself by significantly lowering the immediate cash payout and shifting considerable value to these conditional CVRs. This suggests the company, or at least the counterparty in this deal, has found issues that make the original terms untenable. It is a move that likely protects the acquirer from unforeseen liabilities, but certainly dilutes the immediate return for existing ESSA Pharma shareholders. The fact that they are pushing out the shareholder meeting and have a lengthy list of forward-looking risks, including potential litigation and increased costs, paints a picture of a deal that is facing significant headwinds. It is not a smooth sail, it is more like navigating through choppy waters. Given these adjustments, ESSA Pharma's strategic direction seems to be pivoting heavily towards contingent outcomes. Their future value is now heavily tied to how well they can resolve these potential liabilities and how much value these CVRs will actually unlock. Without seeing the direct terms of those CVRs and the specific liabilities they address, it is hard to give a firm valuation. However, the drastic cut in immediate cash signals a more cautious, perhaps even distressed outlook on the immediate financial health of the combined entity or the target of the acquisition. For shareholders, this filing is a wake-up call. It means reassessing expectations and understanding that a substantial portion of their potential return is now in the, if all goes well, bucket. They need to closely monitor the resolution of these liabilities and the market's perception of the CVRs. This is a story of a deal that has been reshaped potentially to salvage a difficult situation, but at a significant cost to immediate shareholder gains. It highlights the inherent risks in biotech mergers where future clinical or regulatory success, or the lack thereof, can fundamentally alter the value of a transaction. Alright, that is our breakdown of ESSA Pharma Incorporated's latest filing. What is your take on these number changes and what they signal for the company? Future, do these CVRs offer real hope, or are they just a way to sweeten a much less attractive deal? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.